Hello and welcome to another episode of Darwin Investors. Today we're going to have a look at next week's most anticipated earnings release. I'll let you know how I plan on playing some of these companies and try and make a little bit of money next week. I'll give you some of my thoughts on some that I'm not going to play. It doesn't mean just because I'm not going to play them doesn't mean that they're not going to make money. I mean, some of these companies are making money like crazy as retail investors just kind of pile into some companies that are having some pretty questionable earnings. I'll show you what Carvana did last week. It's kind of funny. Um, but yeah, right now I'm pretty bullish. And so I won't be selling covered calls like I used to. I'm going to switch my strategy. I'm going to shake it up a bit. I'm going to be mostly making my money from selling puts, allowing my underlying to just kind of go up on my existing shares. Um, and I'll probably be like start dabbling in doing some credit spreads, like bull put spreads. And I'll give you an example of one that I might do this week. We'll see if I feel like gambling or not. All right, let's get into this. So about 87% of the S&P 500 has already reported earnings. And you might think, well, that means that earnings season is pretty much over. But now there's a lot of companies out there that can still report earnings. And unlike the first part of earnings season, at this time of earnings season, you're going to have a lot more insight into the type of numbers that a lot of these companies are going to be reporting. So it makes it a lot more of a safer bet or not as much gambling as it would be, say, earlier in earnings season. Now, looking at the companies that are reporting this week, we've got some interesting ones. We got Upstart on Monday, Take-Two Interactive, Tattooed Chef reports after the bell, and Palantir reports before the bell. Take-Two is one that I'm pretty interested in. Upstart is actually a lot better company than people think they are. SoFi did well, maybe Upstart will do well. Tattooed Chef is a popular retail stock. It's hyped up a lot by, say, Jeremy on financial education. I love his channel. I hope he makes millions and millions of dollars with Tattooed Chef. I like him because he's a bull. There are very few bulls out there. I think we've got like Jim Liebenthal on Halftime Report. We've got maybe Josh Brown, Tom Lee, Marco Kolanovich at JP Morgan. And then on YouTube, you got me and you got him. So naturally, I like the guy and I hope he does really well with Tattooed Chef. I tend not to like those kinds of stocks at the moment. One, because they're losing money, but the other one's because it's a very crowded field. You know, there's a lot of competition out there for vegetarian frozen food. And I don't know. I don't know what sets them apart. But best of luck. I hope he makes a ton of money. Palantir, this one reports before the bell opens on Monday, so that ship is kind of sailed. I am bullish, like I said right now, and if I was raging bull, I probably would own these shares already going into this earning. And people don't really know what Palantir does. What they do is they're like counterterrorism software for the government. They also do a lot of data analytics for smaller companies with a software package called Foundry. What companies do with these analytics, I don't know, perhaps advertising. And then they also have another software package called Apollo that allows people to transport their uh, software applications across different platforms. Perhaps your application is made for Windows or Apple and you want it to go on Linux. Maybe it'll allow your package to go there. I don't exactly know what Apollo does. I don't invest in Palantir, but as far as I know, that's kind of what they do. And on Tuesday, we've got Capri Holdings kicking it off. Capri Holdings does like high-end apparel. Their biggest thing is in handbags. It's this Michael Kors. I feel like I've heard of that. It's a pretty big company. I think that between Capri and Tapestry, Tapestry does like Coach bags. I've heard of those. I know everybody's got those things. But Michael Kors, I think, is really big too. They also have Jimmy Choo and they have Versace. And so Capri would actually give us a good window into what Tapestry is going to look like. I'm going to hold off on Capri. If they do really well, I'll go ahead and make a play on Tapestry later on in the earnings season. Next, we've got Global Foundries. They do semiconductor equipment similar to Taiwan Semi or Kulik and Sofa Industries. However, this company is not profitable, and since they're not profitable, I'm staying away. Ichor is the same thing as Kulik and Sofa and Taiwan Semi. They do semiconductor equipment. They are profitable. They treated a reasonable valuation for a long time term buy and hold type of trade. This is actually probably not a terrible one. They are fairly priced right now. but they just don't have a lot of interest. So I can see where they would just be flat year after year after year. It's not one I would be interested in at this time or maybe ever. Louisiana Pacific does siding on homes, like new home building, and home builders aren't one that I'm really excited to get into at the moment. There will be a day where I will really like this a lot, but not right at the moment. Ralph Lauren is, of course, an apparel. We all know what they are. It's polo. Seems very popular at the moment. They could buck the trend of people having difficulty selling apparel. We've heard about Target and Walmart having a lot of problems selling apparel. Maybe Ralph Lauren will buck the trend, but I'm not sure. I'm not too hyped up on one that's selling clothes right at this time. Wynn has huge exposure to Macau over in China. They have no Vegas properties. They're, of course, a casino. Casinos are really hopping right now. MGM just reported a very good quarter. You would think that would mean that Wynn might report a good quarter, but we can't be sure because they don't really operate in the United States. I think they operate in Singapore as well. Trade Desk is in the online advertising business. They're a kind of a popular retail stock. We'll look into that one a little bit more. Same with Roblox. They're not online advertising, but they're a metaverse play. And Unity Software is more like mobile gaming and that sort of thing. Then on Wednesday, the biggest thing that we have going on is going to be the CPI release. That's going to be 8:30 a.m. on Wednesday. But there are a couple of good companies reporting on that day. We've got Disney reporting after the bell. That's one that I will be making a play on. And then we have Coupang, which is, I think, a very interesting South Korean e-commerce play. They're kind of trying to turn it into a monopoly out there in that country. They have a lot of competition, but they do seem to be taking over. And then we have Dutch Bros. Another popular retail stock. We'll have a look at that one. And then on Thursday, Rivian reports, as does Six Flags. All right, so let's first have a look at the companies that I will be making a play on this week. The first one on the list is going to be Take-Two Interactive. They're a video game software company. They have titles such as Grand Theft Auto, Red Dead Redemption, NBA 2K. They're trading for $127.16. They report on the 8th of August after market close. 14 analysts cover the company, and the consensus estimate is 86 cents a share, with the high and low of 99 cents and 50 cents respectively. They have a price to earnings ratio of 35 with a forward PE of 23 and a very nice PEG ratio of $1.05. Their profit margins are about 11.93%, and their forecast to grow 33.93%. Morningstar does cover the company. They give them a fair value estimate of $185. The biggest thing they have going right now is with this Zynga acquisition. It brings them into the mobile gaming arena, and that's a very popular arena to be in right now. It's a company that I don't mind owning, so I don't mind selling puts on them. That's the biggest thing about selling puts, is you got to make sure that you don't mind owning the company. And so when I look at their technicals here, I can see that they trade, it looks like here, between $134 and say $120. That's sort of like their support right here and their resistance right there. And right now they're trading right in between. That's part of the reason why I find this to be such an attractive trade. And so what I'm going to try and do is sell a put slightly below their point of resistance at about $119. So at $119, I would be getting $2.24 a share, and every contract's 100 shares. So I could collect $224 a premium on Take-Two Interactive, provided they stay above $119 by the 12th of August. Now, I'll be getting out of this like the day after I sell this put, because the CPI results will be coming out on Wednesday morning, and that could just completely crash the market regardless of how these guys report. So I'll be doing this, and I'll be making a quick exit. I wouldn't be collecting 224, but if they do report lights out earnings, I might be able to collect, say, 175. Now, the next company that I'm going to be making a play on this earnings season is going to be Disney. We all know what they are. I expect that their parks are going to be doing really well, as travel and entertainment stocks tend to be doing well this earnings season. Take Marriott did well, Airbnb did well, the airlines are packed. So we would expect that Disney's going to have packed parks. However, they are in the cruise industry and those have been hurting, and they are in the streaming industry and that has been hurting. I know Netflix shares popped after they released their results, but to be fair, I don't think that their results look that good. And Warner Brothers Discovery, who's the parent company of HBO Max, they reported last week and their earnings were a catastrophe. So Walt Disney could be one that could backfire on me. I'm going to do it anyway. Let's take a look at their fundamentals real quick. So Walt Disney will be reporting after market close on the 10th of August. That's Wednesday. 23 analysts cover the stock, and the consensus estimate is for 97 cents a share with a high of $1.36 and a low of 61. Their price to earnings ratio is 72. However, their forward PE is quite reasonable at 27.19. Their PEG ratio is 1.81. They have a profit margin of 4.15%. But again, the growth projected out of this company is supposed to be really, really nice. Let's look and see what their technicals look like. So when we look at Disney, they tend to be trading in this channel here between, say, 110 and say $90. And they're trading near the top of this channel right now, which makes me a little bit nervous. They also they also report earnings on the same day that the CPI report comes out. So that's going to make me a little bit nervous as well. It looks like if you're able to get them under $90, that would be really nice. But realistically, I think under 100 is probably going to be okay. This was 100 used to be an old resistance, so it looks like it could be new support. So I would trade for something just below their old resistance. If you look and see how much we could get for Disney puts at $99, it looks like with a $99 strike that expires on the 12th of August, we can get $82 per contract right now. Again, I would not be selling puts on Disney until after the CPI read comes out on Wednesday morning, because that could flush this entire market right down the toilet. The next company we're going to have a look at is going to be Upstart Holdings. We would expect that this company would do pretty well in earnings because SoFi did pretty well in earnings. They trade at $29.60 a share. What they do is they use an AI platform to determine whether someone would be a good borrower of money. Rather than using something like Experian and downloading a credit report, they have software that will tell you whether or not someone will pay you back. Again, they report on the 8th of August after market close. 12 analysts cover this stock. The consensus EPS is for a penny with a high of 37 cents and a low of -8 cents. They do have a price to earnings ratio at 17.95. They're projected to shrink this year. Next year's forward PE would be 21.99. Their PEG ratio is below 1, which indicates that this is a very good growing company. And their growth forecast is 25%. Their net profit margin is 15.82. If we look at their technicals here, we can see that right now they're trading in a channel, say, between 31 and 21. So if I was in raging bull mode, this would be a company that I would be actually just buying the shares, crossing my fingers and hoping that it goes up to like $40 after they report, which it actually could. But right now what I'm going to do is probably a bull put credit spread, a vertical spread, and I'll show you what I'm going to be doing on that in an Excel spreadsheet. That's if I feel like gambling tomorrow. I'm off work, so I probably will gamble. When we look at the last quarterly earnings of Upstart, we can see that they did project out $295 to $305 million this quarter is what they were going to produce in revenue. Their net income, they did project it could be negative, and that could be part of the reason why the stock has come down. However, their adjusted net income would be 28 to 30 million, and that's what gets reported whenever they're going to report earnings. Now, they projected 295 to 305 million. However, the consensus that they have to beat is 235 million. And so 295 is a lot more than 235. So we would expect that this company would beat on revenue. And because of SoFi's results, we would expect that this company would have a pretty nice pop right after earnings, probably maybe even as high as, geez, I don't know, 35, maybe even $40. And so this would be a company that I would, if I was in raging bull mode, I would be owning these shares prior to earnings, throwing the dice and seeing if I can't make some money. Let me show you how I might be able to make some money on Upstart using a bull put vertical spread. Now, Upstart is currently selling for $29.60. If I sell a put for $27 strike that expires on the 12th of August, I can collect $2.89 in premium, and it's 100 shares, so it's $289. I can also buy a put with a $23 strike and buy it for $126. Let me show you the way that this looks like on a spreadsheet. So here is the bull put vertical spread. Vertical because both of them expire on the same day. Put because they're both lower than the current price that the stock is trading at. Bull because I make money if it goes up. So if this stock ends up over $27, then I would make the difference between the two strikes. Because remember, I'm buying this one for $126 and I'm receiving $289 for this one. So the stock right now is currently trading at right around $29. So if this stock were to just trade sideways after earnings or go down a little bit or go straight up, the max reward that I could get out of this trade would be $163. My max risk is the difference between the two strikes minus what I've collected. So my max risk would be $237. And so this would be a way that you could use a bull put vertical spread to try and make $163 off of Upstart on earnings should it trade sideways, slightly down or up. All right, so now that I've told you about the stocks that I do plan on making a play on this week, let's look at some popular stocks that I won't be making a play on, but some that some people might be interested in. And first on that list would have to be Palantir. So they're trading right now at $11.45. They report before the bell on Monday. So any options on this company, that ship has already sailed. But what would we expect this stock to actually do on that day? Well, it is a popular retail stock, so all bets are off. It'll probably go up just because of that, regardless of how they report. However, they do generate a little bit of interest from institutions as well. And should they actually produce, say, a profit or give a guide to a profit or just anything that says that this company is going to profit, I can see where this company would actually go up to, say, even as high as, say, $15 a share. They could have a very good day on Monday. Another company that's going to report that I'm not going to be playing with, but let's just have a look at it. That's popular retail stock is going to be Tattooed Chef. It's currently trading at $7.64. If we look over here at the technicals, it is trading at the top of its range. That's unfortunate. I don't see it having a lot of upside unless it reports a lights out quarter. If they guide to profit, if somehow they're able to say that they're going to be able to be more profitable sometime soon, I could see them trading as high as $9. But more likely, they're going to trade back down to $7. That's kind of the way I see it. Well, hopefully, this old resistance becomes new support, and then slowly over time, this company can inch its way up as it becomes more profitable. Any conversation of Tattooed Chef around earnings time has to consider their percentage of shares outstanding that are sold short. Right now, they have a pretty high short interest of 17.53%. They are a micro cap company trading at about a $630 million market cap. So any kind of like really huge exuberance out of the retail trading community does have the potential to drive this stock considerably higher. It's not something I would count on, but if you look at Carvana here, it's not outside the scope of reason. They reported on after the bell on the 4th of August. If you look at their financials here, what they reported was an earnings miss of 18.2% and a revenue miss of 3.21%. They were expected to generate a loss of $1.98. They reported a loss of $2.35. They were supposed to generate $4.01 billion in revenue, and they missed there and only generated $3.88 billion in revenue. However, due to their short interest, that company did manage to go up on those numbers 46% on Friday. So anytime you have a company that's highly shorted, such as Tattooed Chef, this is always a possibility. So the next company we're going to have a look at is another popular retail stock, and that's going to be the Trade Desk. Trade Desk is in the digital advertising industry. They're currently trading for $52.78 a share. They are reporting after market close on the 9th of August. For that reason, I wouldn't be touching this trade because the next morning, the CPI data comes out. We're expecting inflation to be up 8.7% year over year. If this number comes in really hot, say something in the 9 range, or God forbid the 10 range, the whole market is going to collapse, I believe. And so for that reason, I'm going to be staying away from any sort of trades that take me through that inflation print right there. There are 13 analysts that cover Trade Desks. Their consensus earnings per share is 20 cents with a high of 23 and a low of 16. So they are a profitable company. However, they trade very rich at a 262 price to earnings ratio and a forward PE of 56. Again, it's not a company that I would be personally investing my money in. They have a profit margin of 7.78%. With a growth forecast of 25%. They're not really short sold. They are a company that does look like they might have a good business. Their company profile shows that Trade Desk operates as a technology company in the United States and internationally. The company operates a self-service cloud-based platform that allows buyers to create, manage, and optimize data-driven digital advertising campaigns across various ad formats and channels, including display, video, audio, native, and social on various devices such as computers, mobile devices, and connected TV. So they do have a really nice business. Right now, advertising doesn't seem to be in favor, as a lot of businesses, as their business slows, do seem to be cutting back on advertising. For that reason, also, I probably won't be interested in Trade Desk at this time. However, it is a popular retail stock, so I decided to cover it. If we look at their technicals, we're seeing that they're trading at the top of their channel here. Maybe they go as high as, say, $55. If they were trading like at $41, I might sell a put down here at 35 or 36. But again, this is just another reason why I'm going to stay away from this company at this time. Doesn't mean that they won't go up. They could go up. But probability says they're probably headed down. Almost regardless of how they report, they're probably going to head down a little bit. The next stock that we're going to look at is another popular retail stock. It's going to be Unity Software. They're currently sitting at $48.06. They report after market close again on the 9th of August. That's a pretty bad omen. 13 analysts cover the stock with an EPS estimate of negative 21 cents, with a high of negative 9 cents and a low of negative 27 cents. If we look at their company profile, we can see that Unity Software creates and operates an interactive real-time 3D content platform. Its platform provides software solutions to create, run, and monetize interactive real-time 2D and 3D content for mobile phones, tablets, PCs, consoles, and augmented and virtual reality devices. So it sounds to me like what they are is they're kind of like in the game engine business. So I looked up Unreal. Unreal Engine is one that will allow video game creators to go ahead and borrow this engine to make their own video games. And so I thought that's what it sounds like Unity does. However, they do it on a mobile level. They do it for phones and tablets and that sort of thing. And so they're the same deal. They give you an engine, they sell it to you, and if you're a video game creator, then you can use their game engine to create video games on your own mobile platform. Let's go ahead and look at their technicals. Well, right now they're trading near the top of their channel at roughly $49, and I mean that's the very top. They seem to trade between $33 and $49. I would expect that unless they say they're going to start delivering a profit, that they're probably going to trade down because this is a company that trades solely on technicals. We're talking about a money losing company. They have no price to earnings ratio, nor are they expected to have a price to earnings ratio. They trade solely on technicals and on retail exuberance. So unless everybody starts piling into this stock and sending it higher, the most likely direction for this stock to go is down. Again, I don't know that that's going to happen, but the probability says it's going to happen. That's similar to the way it was for Trade Desk. The next company on this list is going to be Roblox. That's another popular retail stock. When we look at Roblox, they're a creator of like this metaverse. They're generally marketing towards a preteen audience. Their games do look kind of fun. However, their graphics are not that great. What I'm afraid of is that like people that are really, really young that love Roblox as they get older might decide that they want to play a game with better graphics. And I think that's probably part of what Roblox wants is as these young children grow older, that they will continue to play Roblox. And I'm afraid that what this might be is a bit of a passing fad for preteens. And so I'm not very bullish on Roblox, but again, I've never played the game. It does look like it could be fun, especially if I was a child. But let's go ahead and dig into the financials of Roblox. So right now they're trading at $49.24 a share. They report after market close on the 9th of August. 10 analysts cover Roblox. The consensus EPS estimate is for negative 21 cents with a high of 13 cents and a low of negative 36 cents. They don't have a price to earnings ratio, nor are they expected to generate a profit here in the next year. They do have a net profit margin of negative 25%. Again, just like Unity, this is a company that trades just on technicals. So let's go ahead and look at their technicals. And just like Unity and just like Trade Desk, they're right at the top of their channel. The probability says that this company is going to go down. If they were right around $25, I might be selling puts for $21. However, right now, this is a company that I would stay away from, especially in light of the fact that they are reporting the day before the CPI data comes out. The next company I'm going to be looking at is one that I'm personally interested in. It's Coupang. Coupang is a South Korean e-commerce company. They're kind of thought of as the Amazon of South Korea. There are a lot of e-commerce companies in South Korea, but Coupang is currently the largest. Their stock has been way trending downwards. It's been awful. However, it could be poised to turn around. They own 20% of the South Korean e-commerce market, and they're poised to increase that market share to where they could become a monopoly. South Korea has a large e-commerce market. It's the 6th biggest e-commerce market in the world at $92 billion. And these guys are going to be the ones that appears to take over that market. Let's look at a quick video of one of their distribution centers.
I'm inside Coupang's fulfillment center, just outside Seoul. This company's been dubbed the Amazon of South Korea, and was recently ranked as the country's most valuable startup.
We know the truck it's going to go into, the route it's going to be out on, and then that tells us how it needs to be sorted here and when it needs to leave.
That's propelled founder Bom Kim to billionaire status and made Coupang into a national icon.
So you can see that Coupang is a company that does have a promising future. However, e-commerce companies do have a problem profiting. Even Amazon doesn't profit from their e-commerce divisions of their business. They're profiting from things like Amazon Web Services. Coupang's on technicals show that it's trading near the top of its trading range here. It trades between $20 or $19 and $11. This is a company that I think that if it eventually takes off is going to take off really high. It doesn't matter whether you get into this at $20 or whether you get into this at $35. If it eventually goes to $200, you got a good deal. It's not one that I'm currently going to try and pile into, nor is it a one that I'm going to make a trade on. It's just a one that I'm keeping an eye on in the event that someday that they do post a profit and start going upwards. Next company on this list is going to be Dutch Bros. That's another popular retail stock. They're trading right now at $45, which again is at the very top of their range. I have a whole other video on Dutch Bros. I'll leave a link on it here on the upper right when at the end of this video. I like the company. Actually, I really like the company a lot. I just think it trades really rich. I think more of a fair value here is probably in the low 20s. That's just my data that I had through my research as to what the fair value of this company is. But we don't know how big this could get. And there's nothing to say that after they report earnings that they're not just going to shoot upwards. But again, this is a popular retail stock, and I thought I would cover it. Dutch Bros is currently trading for $44.15. They report after market close on the 10th of August. 9 analysts cover Dutch Bros with a consensus EPS of 7 cents, the high and low being 11 cents and nothing. They are a profitable company. It's part of the reason that I like them. Even though they do have a PE ratio that's negative right now, they do generate a forward PE. I do like the company, like I said. I just feel they're a little bit overpriced. They don't have a profit margin at the moment. Only 4.61% of their shares outstanding are sold short, and they are a small cap company with $7.3 billion in market cap. The next company that I'm going to look at is actually going to be Rivian. It's a company they report on Thursday after the bell. They are currently trading for $35.67. They have a lot of backing from Ford and Amazon. I'm already an Amazon shareholder, so I guess I already own Rivian. But this is a company that I really like, and they actually could go up on earnings quite a bit once they start talking about the fact that they are already making a bunch of these electric vehicles for last mile transport for Amazon, and Amazon's got a whole lot of them on the way. Again, they report on the 11th after close. They have 12 analysts that cover them with a consensus EPS of a negative $1.63, with a high of losing $1.46 and a low of losing $1.93. They have no price to earnings ratio, nor are they expected to be profitable next year. They have the worst net profit margin that I've ever seen at negative 3,911%. However, they have a very small percentage of their shares that are actually sold short. So let's go ahead and look at their technicals. Well, they trade in a pretty narrow range, seems like right now, like between where they are at like $38 and they go down as low as, say, $24. If they were trading near the bottom of this range, then I would go ahead and sell puts. But again, this is one that could really surprise to the upside on earnings. And depending on if I feel like gambling, I might actually do this. I do like their trucks. I looked to see if there were any for sale here in the area, but they're just so expensive. They got one here selling for $112,000, another one for $138,000, $130,000, $121,000. You get the point. This truck is very, very expensive, and it's not one I'm going to be sinking money into at this time. But hopefully their last mile delivery for Amazon, those guys can afford these trucks. Hopefully though the last mile delivery for Amazon will pay off in a big way for this Rivian company. All right, well, that's going to do it. Yeah, if you got anything out of this video, please like, subscribe, hit that notification bell. Until then, we'll see you next time. Have a good day. Bye.